Joining us right now to react to this week's data and the Federal Reserve's rate decision, we want to bring in former Fed Vice Chairman Roger Ferguson. He is former president and CEO of TIAA. He's vice chairman of the Business Council, and he's a CNBC contributor. And Roger, you have been right for a very long time in terms of guiding us what the Fed would actually do. People have gotten carried away, thought they were going to cut rates sooner, thought they were going to do things beyond this. But we did just get a series of data points that suggest inflation is a little weaker, and so is the jobs market, than we had expected a week ago. Does this change the trajectory at all in terms of when you see the next rate cut coming? Or the first rate cut, I should say.
Not really. So first, let's listen to what the Fed itself had to say. Remember, they had the CPI number yesterday and still didn't change their forecast for, perhaps one cut this year. Secondly, I think they're still clearly stating that they need to see more data in the same direction before getting comfortable. So, if there's a cut this year, I think September is the first chance for them to feel sufficiently comfortable. This incoming data, I think, sort of is another building block in the direction of getting comfort. But recognize, back at the end of last year, I think people were very comfortable, and then suddenly we had the first 3 months of this year. So I think you're going to be cautious. This data does not swing the pendulum dramatically. It moves them in a direction in which they want to go, but they're not there yet.
We were talking to Steve Leisman about it, and as those PPI numbers were hitting, we did see the Fed futures for the month of September jump to 71%. The odds that we see a rate cut in September increased pretty dramatically. Does that match your estimation of what the odds are of a rate cut then?
I would say the odds have gone up, but I wouldn't say 71%. I think, as always, the market is glomming onto a piece of information from one data source, and I think projecting that forward, far too, I would use the word optimistically from their standpoint. We've seen this happen many times, as you pointed out. Expectations of 5 or 6 rate cuts fritter away to 1 or 2, and so I think the odds of a September cut have gone up somewhat, but nowhere near 70-75%. I think that's getting way ahead of where the Fed is right now.
Roger, you still see a lot of data. You talk to a lot of people through the Business Council and beyond, and I just wonder what your sense of the overall economy is right now.
Look, I think the overall economy is actually pretty strong. The economy has performed reasonably well against this so-called restrictive Fed policy. Some of that has to do with what we call the wealth effect, i.e. equity markets have been, very good. Some of it has to do, frankly, with many businesses getting, greater certainty about supply chains, et cetera. I'm also seeing in some of my conversations expectations of continuing to increase wages at around 3%. So it feels to me, while there are some pockets of weakness, overall, pretty good. And calls into question exactly how restrictive monetary policy might be.
Ian Shepperton was with us yesterday, and he made some really good points just about how there are some real pain points in the economy. He mentioned small business in particular, and the idea that they have to pay 9% for loans at this point, that being really something that can clamp down on job growth, because small businesses, which are a huge engine of hiring in this country, can't afford to expand when those are their costs. Is it fair to say that there's a huge difference between bigger companies that we talk to most of the time, between what Main Street is facing, Main Street businesses, and is that cause for concern, or cause for the Fed to potentially ease sooner?
Well, look, part of the challenge is there are sectors that are much more interest sensitive. So, housing has always been talked about as one of those. Certainly small enterprises as well can be. So it is a source of some concern, but this is a very large economy. And so the Fed has to figure out how to think about all of the factors that are driving this. So a source of concern, certainly a source to be taken into consideration, but I don't think it's going to be definitive, because there are always sectors that are doing worse and some that are doing better when the Fed is either in a tightening mode or an easing mode or just standing still. And so I think one takes it into consideration, but you shouldn't sort of overweight a particular sector, because this is a very large, complicated economy, as you well know.
As a former vice chairman, you know pretty well what takes place in the room. How big of a concern would moving too soon be? Just the idea of doing something and then having to undo it later, risking credibility?
I think it's a bit of a concern, frankly. First, they know their forecasts aren't as accurate as they would like. Inflation dynamics probably have changed. I think they are worried a little bit about credibility. I think there's a risk that if they cut early and markets, take off, so to speak, they will be in a position where they're having to cut, having to raise rates not because of the underlying economy, but because of equity markets going forward. And obviously, the history of stop-start back in the Volcker and back in the Burns and early Volcker years. So I think that is absolutely part of the story here. They want to be convinced, and they've been very clear that 1 month's worth of data, maybe even 2 months worth of data, is not sufficient to drive conviction.